Thank you for joining us today. What of equity valuations? How have they been affected?
Since the beginning of November, we've seen a sharp rise in global equity markets. The election of Joe Biden, the Democrat president-elect, was taken as a positive for markets. He's seen as a more conciliatory president with a much more global outlook. And whilst I'm sure the US and China will continue to sort of butt heads over trade, we actually think it's a positive rather than the more adversarial tone of President Trump. Then, of course, we had the vaccine news from BioNTech Pfizer vaccine to start with, and then, of course, we've had two subsequent vaccines as well, and that has really got the markets excited, because we can now start to see a way out of this problem rather than the going into lockdown, coming out of lockdown, which is just so destructive to economies. We've also seen a number of companies in our portfolio, many of which we bought into as a result of the pandemic, from them needing to raise money. And we've seen some of them rise very materially as a result of the vaccine news. Companies such as Whitbread, which is the owner of Premier Inns, the Gym Group, second largest low-cost gym operator in the UK, JD Wetherspoons, the largest pub operator, WH Smith. And we had taken relatively small positions in each of these because we knew that the situation could get worse before it got better. But we knew that these were good long-term holdings that would recover when the pandemic started to ease. And looking through into 2021, 2022 and 2023, we think these would be very good long-term investments. So we've seen some really quite material moves in parts of our portfolio. So we've seen a marked re-rating in some companies in our portfolio recently. Companies that we bought into that were having some short-term difficulties because of the pandemic, being shut down by the government in many instances. The likes of JD Wetherspoons, which is the largest pub group in the UK. We were buying in at very much a value price. The shares have been very hard hit. Historically, they've been seen as a growth company, a steady growth company with a valuation to match. But we were able to buy in at what we consider to be a value price. And in the very short term, we knew that the price could continue to go lower potentially, but we were buying into a good long-term story, and one that, as we came out of the pandemic, should recover very sharply. And then that's what we're starting to see. We've got a number of examples. There was also Whitbread, which is the owner of Premier Inns, again had some short-term issues because of the pandemic, but this is a market leader in the UK, and as we come out of the pandemic, then you'll start to see those hotels filling up. There's considerable pent-up demand, and they will continue to expand, and they're going to have greater pricing power because a number of their competitors, are in financial difficulty. Whereas Whitbread, it raised money early to protect its balance sheet, which has also given it some capital to continue its expansion plans.
Thank you, Oliver. That's very interesting. How has the stock market responded to the pandemic in terms of primary opportunities?
In the early stages, we saw companies, typically raising money in order to protect their balance sheet. Companies that have been, badly affected by the lockdown. But more recently, and into later summer, into autumn and winter, actually we've seen companies that have been trading well throughout the pandemic, and they want to raise money in order to expand what they're doing, perhaps make some acquisitions as well. And what I would say is the stock market has actually acted very rationally during this period. Those companies that required money actually have been well backed by their shareholders and new shareholders, because we can see that even those companies that are having some short-term difficulties actually are going to go on as we come out of the pandemic to recover, and in many cases they'll actually increase their market share.
You've been known to describe this fund as a diversifier and a staple for UK exposure. Why is this a good fit for investors?
Yes, so we run our money in a very different way to other UK equity funds. We like to invest at the stage the company is raising money through our primary opportunities approach, and we believe that gives us a knowledge advantage, because the company has to bear all with its books, so us and other potential investors can look at the deal. And a good management team is raising money now in order to expand its business, not only into 2021, but 2022 and 2023 and beyond. It's also a well diversified portfolio. We have 60 to 80 stocks in the portfolio typically, and it's across large cap, mid cap, and small caps, and we focus on companies with a market capitalization of £100 million. And we look to have a really good spread of companies across the different sectors.
Bearing that in mind, Oliver, what would you say were the key drivers of performance this last year?
So we've seen the small caps actually perform relatively well. The small cap index is actually slightly up on the year, which compared with the FTSE 100 and the FTSE 250, which are both showing sort of material losses. The AIM market, again, those are typically smaller companies, has performed well, and again is in positive territory this year. So those have both been beneficiaries. They're around about 30% that the fund has in that area. They perform well, those areas, because there are a good exposure to technology companies and healthcare companies, which have been able to expand during the pandemic. Company I particularly like to mention is a software company called IMI Mobile. Now, if you ever get a text message from the NHS saying, please come in for a checkup, or hopefully soon you'll be getting one saying, please come in for your vaccine, that almost certainly will be IMI Mobile software. And this company we bought into in the summer. It raised money for its expansion purposes, but actually recently it's received a takeover approach from US tech giant Cisco Systems. It wasn't a huge holding in the portfolio, around about 1.2%. It's now bigger than that because the shares have appreciated in value. But there are parts that have done well in the portfolio. Having said that, there are other areas which have been more disappointing, and it's actually been your larger caps, those that are economically sensitive, the oil companies, the likes of BP and Royal Dutch Shell. Some of the construction businesses have stalled, and banks as well. They were forced to abolish their dividends. And even though they're actually well capitalized, the authorities would not allow them to pay dividends this year. But in all those cases, as a recovery starts to come through, which we expect to see as a result of the vaccine news, we should start to see those companies recover. They are typically large companies. They're paying dividends now, and in the case of banks, they're going to start resuming dividends in 2021. So actually, in terms of the economic recovery, they are good places right now to be.
Thank you, Oliver. I think that rounds up our chat for today. Maybe we can touch base again in a few more days.
Absolutely, that would be good.
Thank you.